Let's move and do a quick recap from the previous session. And then, so in the previous session, the first thing that we talked about was different types of the taxes. And you remember that we talked about that in Canada, we have different types of taxes. What we're talking about is the income tax. And for the income tax, we have three different types of tax returns that in this course, we're going to cover two of them, the T1 for the individuals and the T2 for the corporations. And then we talked about that the tax in Canada is based on residency, and we discussed that residency has a lot of rules attached to it, but one of the simplest rule for a residency is that anyone who has been in Canada for more than 183 days is considered a Canadian resident. And we have some others, those for those who has tie here, spouse, children are living here in Canada, they considered as the Canadian resident as well, and they have to pay taxes. And then we talked about the tax system in Canada, and we discussed about that tax system in Canada is based on brackets. It means that the higher the income, the higher the tax rate that we need to pay. And then it starts from zero, goes up all the way to 53.53 in BC and Ontario. Other provinces is a little bit different, but it's the whole logic. And the tax is a combination of provincial and federal tax. So we have two parts. So we pay the tax to the province and to the federal government. And then we talked about different types of income in the Income Tax Act or ITA. You have either active income or passive income. For the active income, we talked about that there is two options, which first one is the employment, and the second one is the business. So for the employment, it's whatever ever you make is taxable. By taxable, I mean that it goes into those brackets. And for the business, you can deduct the expenses that we talked about it, and the expenses that are related to the business, they are not capital expenditures, and they are reasonable. So we can deduct them, and at the end, whatever left, it's 100% taxable. So you have to pay tax. It pours into those brackets. And on the other side, we have passive income, that the income that comes from the assets. It can be from like financial assets, like investments, and it can be from intangible assets that is called royalty. And then it can come from the tangible assets, like what? Like the property, which is called the rental income. So rental income is an income that comes from the property, but it's more like a business income. Why? Because you can deduct the expenses from that one. And then for the investment, all the passive income, since the value goes up, there is something that's called capital gain. And the capital gain on the individual side, the first $250,000 is 50% taxable. It means that 50% of it is tax free and you don't need to pay tax on it. And 50% is taxable and we need to pay tax on it. And the rest, anything over $250,000 is 66% taxable. And we have to pay more tax on that one. And then what else did we talk about? Yeah, we talked about this concept, which is very important, deductible versus credit. Tax deductible means something that you can deduct from your taxable income, while tax credit is something that you can deduct from the tax payable. So it's different. And sometimes we talk about stuff that have credit. Sometimes we talk about stuff that has, you know, tax deductible. And in the registered account, we're going to talk about it in this session. For the tuition the stuff, we're going to talk about this one as well. So any question here? Is it clear? Then we talk about these three concepts as well. Net gross income, net income, and taxable income. And we talk about it that the net income is the base for all the benefits that we get in Canada. So let's go for this session. In this session, I will go for mostly discuss the tax forms. So first thing that whenever you work as an employee, you're gonna get a form like this at the end of the year from your employer. So this form is called the T4, a statement of remuneration paid. So, okay, Basma is here. So this is very important. In tax system in Canada, all the boxes, lines, everything has number. And a lot of time, we do not talk about, when we want to talk about that, for example, the income in the T4, we always talk about box 14. So you should make yourself familiar. That's why I am just showing you all these boxes here that you become more familiar. Because the technical, when you're technically speaking, just trying to support people, you will be able to, you should be able to use these box numbers. So first thing is the employer's name here. Here on the field one, you're gonna see the employer's name. And then employer's account number, if they have a payroll account that there has something like RP in the middle, 001, and another 9-digit before this one. It's generally how it's shaped. And then this is the social insurance number or SIN number of you or the employee is there. And this is the name and the address of the employee. Okay? So there are some common boxes that are very important, and we're going to talk about this. So the first common box is box 14. Box 14 shows the growth amount, gross salary. So for example, you was hired in a job for $50,000, $100,000, $200,000, doesn't matter, a year. So here you're gonna see that amount. It's definitely not the amount that you got paid. Then what you're gonna see is the employee CPP contribution, which is box 16. And box 16, when you are an employee, there are 3 deductions that you're gonna get. They are mandatory deductions that you have to pay. The first one is CPP, Canada Pension Plan. Then the next one is EI, and the last one is tax. So for the CPP and EI, we discussed it later, in another session on Saturday. I'm not going to jump into all the details of that one. It has something between 5.6 to 0.61 to 6.1, and it's both paid, the employer and the employee both paid the same. So this what you're going to see here in box 16 is the employee part, the amount that you as an employee has paid. And then, so the EI is 1.6%, and the amount that you're gonna get for the EI is gonna come here on box 18. So these are very important to know the boxes, box 18. And then the tax deducted from you is gonna show up on box 22nd, box 22. So I want to show you a trick. Whenever you saw a person T4, if you want to understand how much was the approximation of the take home amount, the cash that they got, you're going to just do this one. Box 14 minus box 16 minus box 18 minus box 22. If you deduct them all, you're going to get to the amount that they took home. Unless they have other deductions like disability insurance, I don't know, critical illness insurance, and some other coverages that the companies have, pension, extra pension plan, RPPs, all this stuff that we're going to talk about them later, probably not in this course. In the next course, we're going to talk about it. Or if you go for the license, then you're going to learn that in the license class. So is it clear? So then there are some other stuff here that is the box 24 and 26. The box 24 and 26 shows the amount that is, EI insurable. It's usually the box 24, 26, and should be equal to box 14. Unless the salary, the box 14 is over $68,000. $68,000 is the maximum. We discussed that one. The maximum amount for what? For the EI insurable part and the CPP. So if the person, for example, if a person makes $100,000 on box 14, you're going to see $100,000. And then on box 24 and 26, you're going to see $68,000. Go ahead, Brian.
Bob, so I wanted to ask a question. With the statement of remuneration paid, right, the T4, the companies at the end of the year, do they send a filled one, or you have to use the company's maybe pay slips to fill the T4 for the client?
No, you don't need to fill the company's payroll system. They have to prepare this form and they send it to the client. So, and the law, they have a legal mandate to do what? To create two copies. One copy should be given to you, the other copy should be given to the CRA. So
Okay.
there is something when we go to the SimpleTax software, I will show you how you can do that one. There is something that called AFR, Auto File My Return. And in the AFR, you can down if you don't have the T4s that the employer give you, you can't download it from the CRA website. But for those who are their first year because they don't have the CRA account, they cannot use it. But for the others that have used it, they have CRA My account, then it's easy. You just go there, download it. But it doesn't necessarily mean that whatever you have is on the CRA. You may just have some stuff that is not on the CRA website. So you should always, because sometimes the employers, they don't send it to the CRA. They give a copy to you. So at the end of the day, it's your responsibility as a taxpayer to declare the income, even if the CRA doesn't have the copy. Because sooner or later, they're going to get that one. And when they get that one, they come back to you and they send you a notice of reassessment that I will explain it to you later, that what is notice of assessment and notice of reassessment. So they're gonna get back to you and say that, hey, we got a new slip for you that you have not declared. Okay, come here, pay us the taxes, or if you need the refund, if you if they owe you, they won't tell you. If you owe them, they're gonna come after you. This is the CRA rule. So if they get the T4 later and they understand that you have not filed, and if you file, they they owe you, they need to pay you back, they won't let you know. So generally, this is the concept. You should take care of your taxes by yourself. It's all
Um,
your responsibility. Yeah, go ahead.
and and also, when by what at what time is that is each employer supposed to give the T4 to their employees?
Generally, it shouldn't be any time later than the February next year. So those
February
are,
this year?
yeah. For example, if before the end of the February 2025, you
Okay.
need to get your T4 for 2024.
All right.
Yeah, and they need to give it to you.
Okay.
Usually these days, they are just wrapping up the accounts, preparing the T4s and T4 summaries. And if you are an accountant, then you need to file a copy of the T4s with the CRA, and there is a form that called T4 summary with the CRA as well. You need to file both of these with the CRA. But as an employee side, you just need to have the T4. Is it clear?
Yes, please. Thank you.
Okay. Okay. And then the other stuff that is here, the other one is the union due. That union due is sometimes you are a member of a union for some public companies, or or you are a member of an association. For example, for me, I am a member of the CPA. Every year I have to declare that one. I have to pay membership to the CPA. If my employer pays that membership fee, they're gonna put it here, and they're gonna add it back here. For example, let's say that my income was $85,000, and they pay $2,000 to the CPA association as well. So they're gonna put $2,000 here, and this one is gonna go $87,000 instead of $85,000. The reason is that that money that they are paying instead of you, it's still taxable on you. And generally, you can deduct the union due. I will explain it later in the tax return where you can deduct it. And the other things that are here, yeah. And at the bottom, there are some boxes that they can change. For example, box 85, these are the 84, these are the boxes that you may see in the tax return. And whenever you want to file tax return, always make sure that you have entered these boxes at the bottom as well. Because if you don't enter those boxes, if you do the AFR, download it, it will have it, and you need just to check. But if you don't enter that one, then they will come back to you and ask for the extra payment, that refund, or they ask you to pay them back. Clear? So, the system, tax system, and the tax forms are not very complicated. They are very easy to follow. They are designed to be simple. And as you see here, but you need to be able to deal with these couple of boxes: box 14, box 16, box 18, box 24, 26, 22, and box 44. These are the important boxes that you generally see in the tax returns, in the T4s for the people. And then, if you are a student, then you're gonna get a form like this. This form is called T2202. This is for your tuition, the amount that you paid to the university. And in this form, it's the name of the institution, the university that you studied in, then the name of the program, name of the student, the social number, SIN number of the student. It was not mandatory before 2020. Then the SIN number is now, university ask for the SIN number to enter because they want to issue this form for you. And then when they use the SIN number, they send a copy to the CRA. So you can download it from the CRA. I remember in 2019 when I came here for that form, I have to enter it manually because the CRA didn't get the copy of that one. But nowadays they receive the copy of that one, and a lot of students, they forget, they didn't know that they have to claim this one, so they did not get the credit. But now it's on the CRA website, and you can download it from the CRA website as well. So, and this, it has a school type, it's university, student number. Sometimes it's there. A lot of universities, they don't leave it here. And what matters here is, first of all, the number of months that of part-time, if you were a part-time student, or number of months you were a full-time student. So box 24, box 25. And the full-time and part-time student, it matters for some tax purposes. For something like, a lot of stuff, that tuition transfer, everything that's related to that one. It's very useful, and we need to have that one. Enter that manually or download it. And then this is the total amount of this box 26 is the total amount of tuition that you can claim. So tuition is not deduction. It's not deductible. It's a credit. What does that mean? For the credits, I want you to write this one down. We have two types: refundable credit, non-refundable. So refundable credit, it means that if you do not owe tax, you're gonna get that money back. We talked about it. The credit is something that gets deducted from the tax payable. So if you don't owe any tax or you don't have any tax payable, so you're gonna get that refundable tax credit back. For example, one of these refundable tax credit is box 22. The tax that is deducted from your paychecks, if you don't owe tax or the amount of tax that you owe is more than is less than that box, you're gonna get the difference back. But some items like the medical expenses, tuition, this stuff, they are non-refundable. It means that if you do not owe taxes, you're not gonna get this money back. It's either lost or will be transferred to the next year. For tuition, if you do not exercise, if you do not use the credit, it will be carried forward to the next year. Does that make sense? Yeah? Is it clear? Let me give you an example. Let's say that my tax that I owe is $16,000. And then box 22 of my return is $12,000. And the non-refunded the tuition that I have, the tuition credit, is, let's say it's $4,000 or 4,500. Okay? So how do we calculate the tax? The tax is $16,000. So we owe $16,000. We deduct the non-refundable credits first, like what? Like the tuition. So I deduct 4,500 from that one. How much is left? 11,500. Okay? And now I owed 11,500. How much did they pay? The refundable part, box 22. So I deduct $12,000. And then how much is this one? Is $500 refund. I'm gonna get back. Okay? But let's say that your non-refundable, your tax was $5,000 and your non-refundable credit was $8,000 and there was no box 22. Your money was small. Okay? Now, in this scenario, the tax you owe is $5,000. The maximum refundable credit that you can deduct is $5,000. So your tax is zero. And now the $5,000 will be deducted from this number and the rest, which is $3,000, will be carried forward to the next year. Make sense? For example, typically students here, they pay something around $40,000 in tuition for a master's degree. So this is times by 15%. So your credit that you can use is $6,000. So if you have any tax payable up to $6,000, you can deduct it. And then the rest, it's gone. If it's less than that one, you deduct whatever you need and then you go move forward. And this number, the amount will be carried forward. And carry forward simply means that if you don't use it, you won't lose it. Okay? Does that make sense? Okay, wonderful. Now, I will get back to this one. And yeah, there is something else here. It's a very special rule that let you transfer the tuition credit because most of the time students they do not make money that much. So they can transfer the tuition credit to someone in their family. Like what? Like a spouse, father, and mother. So they can transfer the credit. Up to how much? Up to $5,000. Up to $5,000 of the tuition credit can be transferred to the spouse, father, and mother. So it technically means that when they don't have income and they have paid for the tuition, it seems that either their parents has paid that one or their spouse has paid that one. So they can take advantage of that one. But the maximum amount of tuition that can be transferred is $5,000. So the credit is $5,000 times by 15%, which is 7,500. 7,500. 750, sorry. Okay? This can be transferred to the other person, but if they want to transfer this money, it's very important that the student should fill out this part. It has the federal amount and the provincial both. And it's the limit for the BC is for $5,000 as well. So they should fill this one out and sign it and give it to the other person. If the CRA audit them, they should show that one. That I have this page signed with my spouse or with with my child. Okay? So this is it for the tuition. Nothing more than this to share with you. And then this is the tax return, the federal tax return for individuals. First of all, you see that one? It says that income tax and benefit returns. One of the most important thing that why everyone should file their tax return is to take advantage of all the benefits. If they don't file their tax return, they're not gonna get any benefit. Benefits like what? Like child benefit. How many of you have children? You have one, no one else? Okay, Zore. After 18 months being in Canada, you are eligible to collect the child benefit from the government of Canada. Or, others like the GST benefits. It's a quarterly benefits that the government pays. And technically, you know what the GST is? Yeah? Oh, pretty, you have children. Child. Okay, yeah. So for you, 18 months after you landed in Canada, if you filed all your tax return, that is very important, then you can claim for the child benefit. And the child benefit will be calculated based on your previous year's income and all everything. Mina, I think you have child as well. You need to be aware of that one. Because if you don't go claim that one, no one will call you. So, and the other thing that we have is the GST rebate, quarterly rebate. So, do you know what's the GST, what GST is? Huh? GST is like the VAT, value added tax. It's called the general sales tax, and this is based on it's 5%. of whatever you buy in Canada, you need to pay for things. There are some exempt items, like most of the grocery items that we buy, they are exempt. We don't need to pay that 5%. And for three of you that have children, there is something that's going on now. If you buy children's stuff till end of February, you're not gonna pay any GST and PST. So it's technically every child stuff is now on sales for 12% because you can save 12% on anything that you buy. And because I bought a car seat for my daughter, and I was so surprised. Oh, I didn't pay anything now. I got just the price tag that was on it. So it's something that if you want to buy stuff for your kids, it's now the best time to buy. So GST technically is for those who have high income. So the people with the lower income, even on the eligible item, they should not pay the GST. But the government, they made that you cannot say that, okay, Mahdi, you are low income, you don't need to pay the GST. Zohra is high income, she has to pay the GST. Okay? They cannot do that one. So what they did, they said that when you file your tax return, based on your income, we will calculate and an approximation of how much GST you have paid in each quarter. And we're going to get that amount back to you after, every quarter, every 3 months, we're going to get paid that one back to you. So the GST is sorry, July to the next year. So for example, if you file your tax return for 2024, the amount of GST rebate that you're going to get from next July will increase or reduce based on the amount of your taxable income this year. And if you're new in Canada, after you file your tax return, or if you want to help the others, these are the values that I gave to my clients, my first clients after 4 months being in Canada. I gave it to my clients at that time. I helped them file their taxes. Then I helped them how to get their GST amount. And the interesting part is that from the quarter that you landed in Canada, you're gonna get your GST. So for example, a person landed in Canada on June. So that person on June 2024. So when they file their tax return for 2024 and they call the CRA and there is a form that called RC66. You need to fill out that form as well. And then, but the easiest way is to call the CRA. They're gonna ask all the questions and fill that one out for you. Then they're gonna pay from the day that they landed. And for example, that person landed in mid-June 2024. They're gonna get paid for the second quarter, third quarter, and the fourth quarter. And then usually it takes time till the next, if they file their tax return on time and call the CRA on time, then usually it takes them another 3 months. So they're gonna get the rebate for the second quarter, third quarter, and the fourth quarter of 2024, and the first and the second quarter of 2025, which is 5 quarters. Usually they're gonna get a check for something between 1,200 to 1,500. So, it's something that you can do for your clients because a lot of people that file their taxes, they don't do that one, and they can get this money back from the CRA, and it makes them happy. And if in the middle, if there were any other special things, then they're gonna get that one as well. For example, if I think in 2023 there was a $700 rebate for in July. So if they become eligible, they're going to get that one as well. Okay, are we good? No tired? Yeah.
No, fine, sir.
Okay, wonderful. Okay. So this part, usually you do not need to fill the forms. There are some interactive forms on the software. I will show you how it works. But now, if you want to fill the forms, it's the identification information, name, address, email, and the social insurance number, date of birth. And if the person is dead, then you have to file this part as well. I will talk about the deceased person in your level 3 course. And then the marital status, it's very important. Even if your spouse is not here, if their spouse is not here, they are married, they have to fill that married part. And then when their spouse is not here, so they have to enter the information for the spouse manually. Why it's important? Because some of the benefits and stuff like that will be the marital status matters for them. So we have people who are married or single. So a person from single who got married will never get back to single. It will either be widow if the spouse passes away, or will be divorced or separated. So what's the difference between separated and divorce? Divorce is those that have finished their process of the divorce, legal documents, everything is done. And the separated is those that are in the middle of the process. So it's very important because for some benefits like the child support, all those stuff that are very important, that there is huge difference between these two. And then the common law are those that have not got married, but they have common law or cohabitation agreement. And then it's the language that they use. If they become Canadian resident, this is for 2023. I haven't got the 2024 yet. They have not published that one. So if they become the Canadian resident, they landed in Canada, they have to enter the date and months, day and months here. Why this day and months matter? Because they will prorate the some credits. We'll go through that one. I will explain it to you. For example, some credits that are based on the year. So if you were here half of the year, you're going to get half of that credit. And the other thing is when they want to calculate the GST rebate, they refer to this number, this date. That matters. And then they cease to become the resident. If they stop being the resident of Canada and they want to leave the Canada, that is unfortunately happening a lot these days. Then you need to fill out this form as well. And then the province of residency is very important because this province will determine which provincial tax you need to pay. And residency doesn't mean that where you work. You may work online with Ontario, but you are a resident of BC. So you have to pay the BC tax, not Ontario tax. Or you may work in Quebec, and you know that the Quebec, it has a separate, like CRA, it calls Revenu Quebec. So if you work in Quebec remotely, and you live in BC, you need to pay the BC taxes. And you don't need to pay to file another tax return because in BC, in Quebec, they have to file two separate tax returns. And then for the spousal common law, if they do not file the tax return together, if they file together, the software will fill out this part. But if they do not file it together, you need to fill out this part here. Sorry, this part. It's very important. And if the spouse is resident of Canada or not, these are important. Then this is for this is the Nazgos land. This is for the BC. and the First Nation. These are for the First Nations. So usually, during all these years, I've filed two tax returns for the First Nations. I haven't, and in Victoria, were more of them. In Vancouver, less of them. And then, if you are a Canadian citizen, if they answer yes, then they want to ask you that if you want to send their, you know, ballots for the election, if they want to, if you agree to share your address with the Election Canada to send you the ballots for the election. That is, they are not here. If you are under the Indian Act, then they are something here. And this is something very important because a lot of people that we work with them, they are immigrants. And if they have any property outside Canada that they bought for $100,000 or more, then they have to mark yes, check yes here and fill out this form. So why this is what is asking this one? Because when you are in Canada, as I explained it in the previous session, you have to pay Canadian tax on your income worldwide, all around the world. Whatever income you have, you need to pay taxes on it. So they want to know if you have any property outside Canada that worth more than $100,000, and they want to know how much income you make from that. So, and it has two methods. The simplified method that has funds held outside Canada, share of the non-resident corporations, indebtedness owed to by non-resident, interest in non-resident trust, you know, real properties outside Canada. You just check that and enter the amount, gross income from that specific foreign property, and gain or loss from disposition of specific properties. If you have any property, you sell them, the gain or loss that you make out of that one, it should be declared here. It's a simplified method. You just enter one number for each line. But in the detail method, you need to enter all the details of everything here. So you need to enter all the numbers here, and the system will add up for you. And technically, if you use this method, it's very probable that the government of Canada come back to you and ask for this because they want to know how much assets you have where. Yeah, they have business to do with everything of our life. I don't know why, but they are government of Canada. So now here, the actual tax return starts. So the first line that you see here is what? Is the employment income. You see it, box 14 of the T4. What was the box 14? You remember what was that one? Unmute yourself.
Net income?
Net income? No,
No.
no. The gross salary.
The gross salary.
The gross salary that you got. It comes here. Then, if any part of this money was exempt, tax exempt income, if you were in the emergency service volunteering, so that, firefighting volunteers that they have here, you get paid for that one. It's something that it's exempt. It need to be entered here. Then if you got any commission that was included in that one, sometimes you work as a sales rep somewhere, and a part of the money that you get is commission. So it should be included. It's in this number, but it should be included here as well. And wage drop loss replacement contribution, it's another thing that you need to enter. Most of the time for the simple tax return that you're gonna file for the first 1 or 2 years, you're not gonna see any of these stuff. Except this one. If they have any special items like, tips, that they get an Uber drivers, not Uber drivers, restaurant servant, all these people, they have to declare it here. And if they don't declare it here, the CRA is gonna go after them because they know that those who work in restaurant, they usually get tips. So they have to declare that number here. Then if the person was on old age security, then they get a T4, another form that's called T4AOAS, and the box 18 of that one will come here. You know, I don't want you to get yourself distracted by these box numbers here. Most of the time, these items will be filled out automatically by the system. But, sometimes your client may ask, where is this number from? You should be able just to read and go to that tax form, tax slip. So the CPP QPP benefit box 20 from another form that is called T4AP. It's for the CPP after retirement. And then disability benefits, including inline, blah, blah, blah. It's another extra benefit that the people get when they are disabled and retired. And then other pensions, if they have any other pension income, they're gonna get it put here. And these are something that were here, they are not no longer exist. And interest, anything from the bank account. And it's very important. For any interest plus $50, the bank will issue a T5. T5 is something another T slip that you're going to get for interest, dividends, stuff like that. And for anything below that $50, the bank will not issue that one, but the client has to declare it. So it's funny, but for all those dimes and quarters that we get in our savings account as interest, we have to declare it here. If we do not declare them, this government of Canada will come after us. They don't, but it's your legal responsibility to say that. They don't have time, to come for these numbers, but you need to just tell them. Then if they have partnership income, these are the stuff we're going to talk about it, but not here. And the rental income, it has a form that you need to go through that one in a separate session. And it's the gross and net income, capital gain, support payment for spousal support, child support, and then is the if they have the FHSA and they make money, they withdraw money from that account, they have to pay it here. If they have RRSP, we're gonna in the registered account session, I will walk you through all these. You're gonna understand them. And then yeah, so these are most of it. And for then the self-employed income. You remember that I talked about the business income. The business income, it comes here. The gross, the net. It will all add it. Business income, professional income, commission, farming, fishing, different industries. It will come in different line. But total will go to the line 27. You see that one? I said that in the tax system, everything is referred to lines and boxes. So in the tax return, it's lines. On the tax slips is boxes. And the boxes on the tax slips usually are connected to the lines on the tax return. And then, these are the social benefits that people get if they are eligible, have disability compensation, lost their job. Yeah, technically, these are the benefits that the government get a lot of tax from us to pay them. And then you get to the total income. It's the total income that you need to, it's your total income. Now we need to deduct to get to what? To net income. And for this one, let's do it for the next session. I will walk you through that one. I don't want to overwhelm you. How was this one?